Hello, and thank you for tuning in to today's video. I'm Gayatri from Index One, and I'm joined by Chris McAfee and Craig Camille from BX. Welcome to Portfolio Strategies Outlook, which is a quarterly content series designed to keep you informed on market trends and evolving investment strategies. Be sure to subscribe to our email notifications so you don't miss the next video. In this session, we'll recap recent market developments, analyze strategies that have been performing well and those that haven't, and explore emerging investment approaches. We'll also highlight new strategies set to be calculated by Index One, where we're committed to supporting money managers by calculating innovative index strategies and providing timely insights into market trends and dynamics. With that, Craig, over to you.
Thank you, G. Welcome everyone to this video. The collective team between BX and Index One works with 50 investment strategy firms from around the world, and we take great pride in finding some of the very best active systematic strategies that ultimately wind up in an index. And we're very proud of the performance of all of our partners. Today, we're going to talk for a few minutes about how the markets have been behaving and talk about some of the specific strategies and what people are noticing about the markets. So welcome. If we usually start with an old slide. So we're going to start with an old slide. And this one is from a year ago, from March 24th of 2025. We actually presented this slide on this call a year ago. We do these quarterly. And at that stage, we were looking at a chart that was 15 months from January of 24 till March of 2025. Hey, we had a pretty good run from 4750 on the S&P 500 all the way up over 6,000. And we asked ourselves to just say, hey, there's three directions this can go. It can go up, it can go down, or it just kind of go sideways. And so what does the future hold? So if we go to the next slide, we'll kind of see what the future held. So that chart ended in April of 2025. From there, the market had a big run up all the way through 2026. So the answer to the previous slide was up. So it kept going up. But if we bring 2026 into question, this slide goes through December of 2025, and when we last did this presentation, and we kind of asked the same question: are we going to go up, or are we going to go down, or go sideways? And sometimes when you're riding these big momentum trends, you just feel like, well, it's going to continue in that direction. Well, we all know that that didn't happen. So if we go to the next slide, we'll see what the current reality is. And the current reality is, the markets have softened quite a bit. And so this is a one-year chart. And you can see at the top of it, this is the S&P 500 and then the 200-day moving average. You can see the market kind of climbed up near 7,000 multiple times in October, November, December, January, and then lastly in February. But really with the uncertainty around Middle East conflicts and the price of oil and the market getting a little hot, we've seen quite a drop. So we kind of hit near 6,900 for the all-time high, and now we're back as we speak today below 6,500, almost to 6,400. But if we look at the performance, the one-year performance through March 25th, the S&P 500 is up 13.39. But the 6-month return is down 2.5%, and the year-to-date return as of the 25th is down almost 5.5%. And the trend itself just doesn't look particularly good. So what do you do in situations like this? And one of the things we talk about on this call is, kind of what's working and what isn't. And the most obvious way to look at what's working and what isn't is just the way we kind of see growth and value. So the next slide gets into that. So this is the one-year return for VUG versus VTG, or the Vanguard Growth ETF versus the Vanguard Value ETF. You notice that, and by the way, the yellow line is the growth, and you can see that the yellow had a really, really strong performance up until February. And what's interesting is, and we put these two arrows on here, is the lines crisscrossed back in April of a year ago, where you can see that value The growth sort of surpassed value and then went off to the races all the way through the end of the year. But we're now seeing those lines crisscross again the other way. And we're seeing that value, the blue line, intersected growth back in that February timeframe. Again, this coincides with global conflicts, price of oil, questions about the economy, interest rates, et cetera. But we think that's really, really important because our studies have shown that if during periods of uncertainty, confirmed uncertainty, that shifting assets to value doesn't take you out of the market, but it really minimizes your drawdown. And you really can see that play out in this chart. So that's one big thing that we wanted to talk about today was hey, we're still, the markets are still in a pretty good spot if you look more broadly than the S&P 500 in the growth market. And then the next slide just goes into a little bit more detail. And so these are popular benchmarks. And this is as of 2 days ago. But it's kind of sometimes nice to put what's happening in the world in perspective. But of some of the more popular benchmarks, the small cap, the Russell 2500, the mid cap ETF, the Russell 1000 are all having good performance through earlier this week, followed by the low volatility and the dividend growers, all having positive years. The MSCI also +2. Interestingly enough, at the bottom, you get your technology and growth, which are both down pretty sharply this year. But the two major benchmarks are the US bond market or the US aggregate, which is down about 0.5% for the year. And then the S&P 500, which we said is down 3.6 to, actually, as of today, it's down closer to 5 or 6%. The point of this is that we do need to move assets around a little bit if we're going to expect better performance. And the other thing I'll say before I turn it over to Chris is if you had a 60-40 portfolio, we know the 40 would be down about 0.5%, and we know that the 60 would be down about 4%. So you put those in the blender and you're down about 2.5 to 3% through the end of the first quarter. So the 60-40 has not been a great place to be in the first quarter if your exposure is in the aggregate and the S&P 500. So that's kind of an overview of where we've come and where we sit today. And Chris is going to go into a little bit more detail around some of the specific strategies and performance of some of the specific strategies.
So here's a rundown of some of our best performing strategies here. Now, keep in mind, this is against a backdrop of an S&P that's down, as of this morning, 5-ish kind of percent. So we've got it's a very, very different kind of array of strategies. One is that applies more weight to specific factors based on the macroeconomic and market backdrop. That's number one. That's the Crestcast. Then you've got a offshore that's not just off US shore, but all the world except for the US and the EU. Then we have a very low volatility strategy, the Ascent Risk Managed, and then you've got small cap momentum and a large cap momentum. So all sorts of different things can potentially work, and that's really what we seek to offer you at BX as a way to escape from the shackles of cap weighted investing, so to speak. It's really, we think it's important, and we think it might become very important going forward to deliver your clients appropriate returns, to be out of the Mag 7 or the cap weighted business and to be into some strategies that are more sophisticated, so to speak. So we did, create some of the categories which have outperformed, the best, but the low volatility defensive dividend stuff seems to be doing the best in the US. So we thought this was an interesting exercise to go through. So this was as of Tuesday when the S&P was only down 3.6 year to date, and then using State Street value and growth ETFs, you see that the values outperform the growth by 5% year to date, but they're both down. Our category averages, literally every single one of them is outperforming the S&P 500 year to date. So the due diligence process that the BX team goes through when we extract our list of strategies from the thousands that we've observed over time to the 70 that we present to you, on average, you're doing, much, much better than the market. And as Craig pointed out, value is doing the best this year, then international, then SMID, by and large, the market's down a bit and we're doing a bit better than it, which is, nice to see. Now, this is relative to the benchmarks in the category. So the average BX strategy compared to its specific benchmarks averaged throughout the entire category. And you might want to ignore crypto because that's so volatile. But our two Bitcoin strategies, which are both new to the platform this year, are both down very small amounts relative to Bitcoin itself, the coin being down about 20% year to date. So we've got this huge margin of outperformance there. But if you look at our core offerings, the large cap core, the large cap growth, the large cap value, international, SMID, they're all in excess of 300 basis points on average better than their benchmarks year to date. So, by and large, if you're, leveraging BX derived strategies, you're doing very well for yourself and your clients. Switching gears, we're always onboarding what we think are, high value added, new strategies to the platform. So 3 of them are derived from Wealth Trust, which is an RIA asset manager down in Florida. So their AI-driven tactical equity ETF has had just absolutely stellar performance. Their fixed income is really good. Their long-term growth has an extraordinary long-term track record. So take a look at some of these indices if you haven't seen them before. And then we've got the 2 tactical Bitcoin strategies, which I had mentioned are both heavily weighted to cash right now, which has served them really well. It just shows that we're willing to embrace any strategy if we think it's got the potential to add value to client portfolios. Now I'm gonna shut down the presentation for a second so I can pull up another window. So bear with me. So in case you're not familiar with it, because I don't think Craig and I have spent a tremendous amount of time on this call or others discussing this to this audience yet, is the risk shield. This is an innovation that we've been working on for a really long time, and it's derived from the fact that, of all these thousands of strategies that we've looked at and the 70 that we've so far selected, 9 of them have tactical elements where they can rotate to cash or different asset classes, or they can rotate from growth stocks to value stocks, or they can go from more aggressive sectors to more conservative sectors. And we took a look indicators that drive the allocations in these strategies and came up with numerical values for them, right? And then so each one of these 9 strategies has its own speedometer, so to speak. And, we'll share with you the current reading on each of the speedometers. And then on average, they're at an 8 out of 10 right now. So even though the market has felt a little hinky, we don't have these big warning signs flashing in these in this indicator yet. These strategies have all over time delivered substantial outperformance by using their tactical elements, but any one of them can be wrong on any given market whipsaw. But we found that by taking the accumulated wisdom of all 9 of them and blending them together, we get a signal that's much more likely to not get you whipsawed, like unfortunately happens in many tactical strategies. Now, our risk shield isn't really designed to protect advisors and clients from losing that first 5 or 10%. That's almost impossible to do. People that tell you they can do it, I would read very closely the fine print. But what it is really designed to do is, as that 10% pullback becomes a 25% or 35% meltdown, to keep you out of the big meat of that. And right now, there's nothing to indicate that that's necessarily on the horizon embedded within this signal, but it does move fast. We would recommend that you use this as a risk management tool. And if you want to put it on autopilot so that you're not rating the risk shield and then having to make your own judgments as to how much risk to put on and take off and exactly when to do it, we have blended models designed to deliver you the wisdom of the risk shield within an investment model. So if you care to take a look at the BX tactical model or the BX shock absorber model, which is designed to protect downside, the most, you can go ahead and get the benefits of the tactical and the risk management without having to make, advisor-driven decisions, which is always difficult. And this is kind of cool. So this tells you historically where the risk shield has been. So we're a little lower than the 9s that we've been at for the last 8, 9, 10 months, but it's still not in trouble territory. And what you can see here is, the indicator dropped as low as 2 before climbing directly back to like 6+ during the month of May. So what it was telling you was last March and April, there was much more substantial risk that the pullback that we felt was going to become more serious. That didn't wind up happening, which is fine. So those models might have underperformed by a smidge last year, but it's not by much. But what they did do was make sure that if the market meltdown progressed into something terrible, that you would have been protected from it. So gee, those are kind of my comments for today.
Awesome. Thanks, Chris, and thanks, Craig. At Index One, we offer a holistic index calculation platform that delivers fast, flexible, and scalable indexing solutions. And we help build indices based on fully custom strategies, like the ones you've seen in this video, and we have tools for backtesting, index calculation, rebalancing, corporate action features, and distribution. And we've been working with BX for, is it over 3 years now? And we're calculating over 80 indices and continue to collaborate with them on bringing innovative and robust investment strategies to life. And we're very much looking forward to continuing and nurturing that relationship. To our viewers, you can explore all the BX models mentioned in today's session on both BX's and Index One's websites. And in the meantime, be sure to subscribe to Index One's and BX's email newsletters to stay updated on our next portfolio strategies outlook video. Thank you for tuning in, and we look forward to seeing you next time.